Question 1. An individual has a life insurance policy and wants to ensure that if they become totally disabled, their premiums will be paid. Which rider would best achieve this? A. Accidental death benefit rider. B. Waiver of premium rider. C. Guaranteed insurability rider. D. Payer benefit rider. Answer: B. Waiver of premium rider. The waiver of premium rider is designed to keep a life insurance policy in force by waiving future premium payments if the insured becomes totally disabled, ensuring the coverage continues without financial burden during a period of inability to work. This rider is particularly valuable because it protects the policy's cash value and death benefit from lapsing due to an unforeseen disability. For example, if an insured becomes permanently disabled and can no longer earn an income, this rider would prevent them from having to surrender their policy due to an inability to pay premiums. Remember, this rider only pays premiums if total disability criteria are met, not for any other reason. Question 2. According to California law, a life insurance policy must provide a minimum free look period of how many days? A. 7 days. B. 10 days. C. 15 days. D. 30 days. Answer: B. 10 days. In California, a life insurance policy generally must include a provision for a minimum free look period of 10 days, during which the policy owner can review the policy and return it for a full refund of premiums paid if they are not satisfied for any reason. This consumer protection allows individuals to examine the policy's terms and conditions without commitment after it has been delivered. For example, if a policy owner receives their new life insurance policy on May 1st, they would have until May 11th to decide if they want to keep it or receive a full refund. Always inform clients about their right to this free look period to ensure transparency and compliance. Question 3. Which of the following statements regarding the incontestability clause in a life insurance policy is most accurate? A. It prevents the insurer from denying a claim due to misrepresentations after the policy has been in force for a specific period, usually 2 years. B. It allows the insurer to contest a claim at any time if fraud can be proven. C. It ensures that the policy's cash value cannot be reduced by the insurer. D. It applies only if the insured dies during the initial waiting period of the policy. Answer: A. It prevents the insurer from denying a claim due to misrepresentations after the policy has been in force for a specific period, usually 2 years. The incontestability clause is a standard provision in life insurance policies that limits the insurer's ability to deny a death claim based on misrepresentations or concealments in the application after the policy has been in force for a specified period, typically 2 years from the issue date. This clause protects beneficiaries from an insurer trying to deny a claim years later over minor inaccuracies in the initial application, promoting policy stability. For instance, if an insured stated they were a non-smoker but were actually a smoker, after 2 years, the insurer generally cannot deny the claim based on this misrepresentation. Understand that this clause provides significant consumer protection by offering certainty that the policy will pay out as intended. Question 4. All of the following are characteristics of term life insurance, except A. It provides coverage for a specific period of time. B. It builds cash value over time. C. It is generally less expensive than whole life insurance at younger ages. D. It pays a death benefit only if the insured dies during the policy term. Answer: B. It builds cash value over time. Term life insurance is designed to provide coverage for a defined period, such as 10 or 20 years, and pays a death benefit only if the insured dies within that term. Unlike permanent policies, term life insurance does not accumulate cash value, meaning it does not have a savings component or loan possibilities. This absence of cash value is what makes term insurance typically more affordable in the initial years compared to whole life insurance. Think of it like renting insurance. You pay for coverage for a set period without building equity. Question 5. In California, what is the primary purpose of the California Life and Health Insurance Guarantee Association, CLHIGA? A. To protect policy owners, insureds, and beneficiaries against the insolvency of an insurer. B. To regulate premium rates for life and health insurance policies. C. To provide health insurance coverage to low-income individuals. D. To educate the public about life insurance products. Answer: A. To protect policy owners, insureds, and beneficiaries against the insolvency of an insurer. The California Life and Health Insurance Guarantee Association, CLHIGA, was created to protect California residents who are policy owners, insureds, and beneficiaries in the event that a member insurance company becomes insolvent and cannot meet its contractual obligations. CLHIGA acts as a safety net, paying claims and continuing coverage up to specified limits, funded by assessments on other solvent insurers. For example, if a life insurance company goes out of business, CLHIGA would step in to ensure policyholders' death benefits or annuity values are protected up to the statutory limits. This system provides a crucial layer of security for consumers in the insurance marketplace. Question 6. A life insurance policy's grace period typically allows the policy owner how much extra time to pay a past due premium before the policy lapses? A. 7 days. B. 15 days. C. 30 or 31 days. D. 60 days. Answer: C. 30 or 31 days. A grace period is a provision in a life insurance policy that allows the policy owner a specific number of days, usually 30 or 31, after the premium due date to pay an overdue premium without the policy lapsing. If the insured dies during this grace period, the death benefit is still payable, though the unpaid premium will be deducted from the payout. For example, if a premium was due on May 1st and went unpaid, the policy would remain in force until early June, giving the policy owner extra time to make the payment. Always advise policy owners to pay within the grace period to avoid any risk of coverage loss. Question 7. Which type of life insurance policy is characterized by a flexible premium and adjustable death benefit, along with a cash value account that earns interest? A. Whole life. B. Term life. C. Universal life. D. Variable life. Answer: C. Universal life. Universal life insurance is a flexible permanent life insurance policy that allows the policy owner to adjust both the premium payments and the death benefit amount within certain limits. It includes a cash value component that earns interest, often at a declared rate, and transparency regarding costs and interest credits. For example, a policy owner might be able to pay more in premiums 1 year to build cash value faster, or less in another year if their financial situation tightens, as long as the policy remains sufficiently funded. This flexibility makes universal life suitable for individuals whose financial needs or circumstances may change over time. Question 8. In California, which document must be provided to a prospective life insurance applicant during the sales presentation outlining policy costs and other information? A. Policy summary. B. Certificate of authority. C. Binder. D. Underwriting guide. Answer: A. Policy summary. In California, a policy summary is a crucial document that must be provided to a prospective life insurance applicant during the sales presentation, or at the time the application is taken, and again upon policy delivery. This summary details important information about the proposed policy, such as the premium, death benefit, cash values, surrender values, and dividend information, presented in a clear and concise format. Its purpose is to help the consumer understand the key features and costs of the policy being considered, ensuring informed decision-making. Always ensure this document is thoroughly explained to the client. Question 9. What is the primary purpose of the incontestability clause in a life insurance policy? A. To prevent the insured from canceling the policy after a certain period. B. To allow the insurer to deny claims for any reason within the first 2 years. C. To protect the beneficiary from the insurer denying a claim based on misstatements after a specified period. D. To guarantee the policy will pay dividends to the policy owner. Answer: C. To protect the beneficiary from the insurer denying a claim based on misstatements after a specified period. The incontestability clause is a standard life insurance provision that limits the insurer's right to deny a death claim due to misrepresentations or concealment in the application once the policy has been in force for a specific period, typically 2 years. This clause offers significant protection to beneficiaries, assuring them that the death benefit will be paid even if minor errors or innocent misstatements were made on the original application. For example, if an applicant unintentionally misstated their weight on the application, after 2 years, the insurer generally cannot use this to deny a claim. This clause provides peace of mind that the policy will fulfill its purpose. Question 10. When a policy owner replaces an existing life insurance policy with a new one, California regulations require the replacing insurer to do all of the following, except: A. Provide the applicant with a notice regarding replacement. B. Obtain a list of all existing life insurance policies to be replaced. C. Submit the application to the existing insurer for approval before issuing the new policy. D. Send a copy of the notice regarding replacement to the existing insurer. Answer: C. Submit the application to the existing insurer for approval before issuing the new policy. California regulations regarding replacement of life insurance policies are stringent to protect consumers from potential disadvantages. The replacing insurer is required to provide the applicant with a notice regarding replacement, obtain a list of all existing policies being replaced, and send a copy of the notice to the existing insurer. However, the replacing insurer is specifically not required to obtain approval from the existing insurer. Their role is simply to notify them. This notification allows the existing insurer to contact the policy owner and explain the potential ramifications of the replacement. Always follow replacement procedures carefully to ensure compliance and ethical conduct. Question 11. Which of the following is a characteristic of a variable life insurance policy? A. Premiums are flexible and can be adjusted by the policy owner. B. The cash value is guaranteed and stable. C. The policy owner bears the investment risk of the cash value. D. It provides a fixed death benefit that does not change. Answer: C. The policy owner bears the investment risk of the cash value. Variable life insurance is a permanent life insurance policy where the cash value is invested in a separate account, which consists of various investment options like stocks and bonds. Unlike traditional whole life insurance, the policy owner bears the investment risk, meaning the cash value can fluctuate based on the performance of these underlying investments, and there are no guarantees on its growth. This type of policy requires a securities license to sell, as it involves investment risk similar to mutual funds. For instance, if the chosen investments perform poorly, the cash value could decrease, impacting the policy's overall performance. Question 12. Which of the following is an example of an unfair trade practice in life insurance in California? A. Explaining the policy summary to a client before the application. B. Using a sales presentation that misrepresents the benefits or terms of a policy. C. Assisting a client in comparing different policy options. D. Delivering the policy to the insured in a timely manner. Answer: B. Using a sales presentation that misrepresents the benefits or terms of a policy. Misrepresentation, which involves using a sales presentation that misrepresents the benefits, advantages, conditions, or terms of any insurance policy, is a classic example of an unfair trade practice. This practice is strictly prohibited in California as it deceives consumers and can lead them to make uninformed decisions that are not in their best interest. For example, telling a client that a term policy builds cash value, when it does not, is a misrepresentation. Always ensure your communications are truthful and accurate to avoid violating unfair trade practice regulations. Question 13. An individual applied for a life insurance policy and paid the initial premium. The agent issued a conditional receipt. If the applicant dies before the policy is issued but after the medical exam, under what condition would coverage be effective? A. Coverage is effective immediately upon application submission. B. Coverage is effective only if the policy would have been issued as applied for. C. Coverage is never effective until the policy is formally delivered. D. Coverage is effective only if the cause of death was accidental. Answer: B. Coverage is effective only if the policy would have been issued as applied for. A conditional receipt provides interim coverage from the date of application or medical exam, whichever is later, but only if the applicant is found to be insurable as applied for at standard rates. This means if the applicant dies before the policy is officially issued, the death benefit would be paid, provided they met the insurer's underwriting requirements and would have been approved for the policy. For instance, if an applicant passes away from a car accident before the policy is issued, but underwriting shows they were healthy and qualified, the conditional receipt ensures the death benefit is paid. Always explain to clients that a conditional receipt does not guarantee coverage, only that coverage may be enforced sooner. Question 14. What is the main purpose of the entire contract clause in a life insurance policy? A. It states that the policy owner can change any policy provision at any time. B. It prevents the insurer from making changes to the policy without the policy owner's consent. C. It stipulates that the policy document and the application constitute the entire agreement between the parties. D. It allows the insurer to contest the policy for up to 2 years after issuance. Answer: C. It stipulates that the policy document and the application constitute the entire agreement between the parties. The entire contract clause is a standard life insurance provision that states that the policy itself, along with a copy of the application, constitutes the complete and only agreement between the policy owner and the insurer. This clause is critical because it prevents either party from referring to outside documents or statements to alter or contradict the terms of the contract. For example, if an agent made a verbal promise not included in the written policy or application, the entire contract clause would prevent that promise from being enforceable. This provision protects both the insurer and the insured by ensuring clarity and finality regarding the terms of the agreement. Question 15. All of the following are typically considered policy exclusions in a life insurance contract, except A. War. B. Suicide. C. Aviation, non-commercial. D. Hazardous occupations. Answer: D. Hazardous occupations. While hazardous occupations can lead to higher premiums or even policy denial during underwriting, they are not typically listed as a standard exclusion within a life insurance policy itself once issued. Standard exclusions, such as war or suicide, within a specified period, usually 2 years, define specific circumstances under which the death benefit will not be paid. For example, if an insured dies in a war zone, the war exclusion might prevent a payout. On the other hand, if an individual with a hazardous occupation like commercial pilot is insured, the insurer would have already accounted for that risk during the underwriting process, either by charging more or placing limitations on coverage. Question 16. What is the primary characteristic that distinguishes whole life insurance from term life insurance? A. Whole life policies have lower premiums than term life policies. B. Whole life policies provide coverage for a specific period, while term life is permanent. C. Whole life policies accumulate cash value, while term life policies do not. D. Whole life policies do not require medical underwriting. Answer: C. Whole life policies accumulate cash value, while term life policies do not. The fundamental difference between whole life and term life insurance lies in the cash value component. Whole life insurance is a type of permanent insurance that builds cash value over time, which can be accessed by the policy owner through loans or withdrawals, and remains in force for the insured's entire life, assuming premiums are paid. Term life, by contrast, provides coverage only for a specific period and does not accumulate cash value. For instance, a whole life policy taken out at age 30 will still be in force at age 70 with accumulated cash value, whereas a 20-year term policy would have expired. Question 17. An individual purchased a life insurance policy and designated their spouse as the primary beneficiary and their children as contingent beneficiaries. If the primary beneficiary dies before the insured, who will receive the death benefit? A. The insured's estate. B. The contingent beneficiaries. C. The policy owner's legal representative. D. The insurer will retain the funds. Answer: B. The contingent beneficiaries. In a life insurance policy, the contingent beneficiary is the person or entity designated to receive the death benefit if the primary beneficiary dies before the insured. This designation ensures that the policy proceeds are distributed according to the insured's wishes even if the primary beneficiary is no longer living. For example, if the spouse, primary, dies and then the insured dies, the children, contingent, would receive the death benefit, rather than the money going to the spouse's estate or the insured's estate. It's crucial to name contingent beneficiaries to avoid complications and ensure the payout reaches the intended parties. Question 18. What is the primary purpose of a life insurance policy's suicide clause? A. To prevent the insured from committing suicide. B. To exclude coverage if the insured commits suicide within a specified period, usually 2 years. C. To provide an additional benefit if the insured commits suicide. D. To allow the insurer to investigate the cause of death indefinitely. Answer: B. To exclude coverage if the insured commits suicide within a specified period, usually 2 years. The suicide clause is a standard provision in life insurance policies that states if the insured commits suicide within a specific period, typically 2 years from the policy's issue date, the insurer will not pay the death benefit but will refund the premiums paid. After this initial period, if the insured commits suicide, the full death benefit will usually be paid. This clause is designed to deter individuals from purchasing life insurance with the intent of committing suicide shortly thereafter. For example, if a policy is issued in January 2023, and the insured commits suicide in December 2023, only the premiums paid would likely be refunded. Question 19. If a life insurance policy lapses due to non-payment of premiums, which non-forfeiture option allows the policy owner to continue the original coverage amount for a reduced period? A. Cash surrender value. B. Reduced paid-up insurance. C. Extended term option. D. Automatic premium loan. Answer: C. Extended term option. The extended term option is a non-forfeiture option that uses the policy's accumulated cash value to purchase a single premium term insurance policy for the same face amount as the original policy, but for a limited period of time. This option allows the policy owner to maintain the full death benefit coverage, even if for a shorter duration, without further premium payments. For example, if a policy with $50,000 cash value and a $200,000 death benefit lapses, the $50,000 might be used to buy a $200,000 term policy for another 10 years. This is often the automatic non-forfeiture option if no other choice is made. Question 20. According to California law, what is the maximum interest rate an insurer can charge on a life insurance policy loan? A. 6% fixed. B. 8% fixed. C. A variable rate not exceeding a specified maximum, or a fixed rate. D. The prime rate plus 1%. Answer: C. A variable rate not exceeding a specified maximum, or a fixed rate. In California, insurers may charge either a variable interest rate on life insurance policy loans, which cannot exceed a specified maximum, example 8%, or a fixed interest rate, typically 8%. The exact regulations are designed to provide flexibility for insurers while protecting policyholders from excessive loan interest. For instance, a policy might state the loan rate is 6% fixed, or it might state it's a variable rate tied to an index but capped at 8%. It's important for agents to clarify the specific loan interest rate terms with clients when discussing policy loans. Question 21. Which rider in a life insurance policy would provide an additional death benefit if the insured dies as a direct result of an accident? A. Waiver of premium rider. B. Guaranteed insurability rider. C. Accidental death benefit rider. D. Living benefits rider. Answer: C. Accidental death benefit rider. The accidental death benefit rider, often called double indemnity, provides an additional amount of death benefit if the insured's death is caused directly and solely by an accident, typically doubling the face amount of the policy. This rider enhances the policy's payout for a specific type of death, rather than providing coverage for disability or future insurability. For example, if a policy with a $100,000 face amount includes this rider, an accidental death would trigger a $200,000 payout. Remember, this rider only pays if death is purely accidental and meets the rider's specific definitions. Question 22. What is the primary characteristic of an annuity? A. It provides a lump sum death benefit upon the death of the annuitant. B. It is a contract that liquidates a sum of money into a series of periodic payments over time. C. It offers coverage against premature death. D. It accumulates cash value that can be borrowed against. Answer: B. It is a contract that liquidates a sum of money into a series of periodic payments over time. An annuity is fundamentally a financial contract designed to provide a stream of periodic payments to an individual, the annuitant, over a specified period or for their lifetime, typically used for retirement income. Unlike life insurance, which protects against dying too soon, annuities protect against living too long by ensuring a steady income flow. For instance, a person might deposit a large sum into an annuity, which then converts that sum into monthly payments for the rest of their life. Its core function is the systematic liquidation and distribution of accumulated funds. Question 23. All of the following are typical settlement options for life insurance policy proceeds, except A. Lump sum. B. Fixed period installments. C. Fixed amount installments. D. Annual renewable term. Answer: D. Annual renewable term. Annual renewable term is a type of term life insurance policy, not a settlement option for policy proceeds. Settlement options describe the various ways a beneficiary can receive the death benefit from a life insurance policy. Common settlement options include receiving the entire death benefit as a lump sum, having it paid out over a fixed period, or receiving a fixed amount periodically until the proceeds are exhausted. For example, instead of a $500,000 lump sum, a beneficiary might choose to receive $5,000 per month for 10 years. Question 24. Which of the following best describes the purpose of the Medical Information Bureau, MIB? A. To provide medical treatment for insureds. B. To store and share medical information among insurers to detect misrepresentation and reduce adverse selection. C. To conduct medical exams for insurance applicants. D. To regulate health insurance premiums in California. Answer: B. To store and share medical information among insurers to detect misrepresentation and reduce adverse selection. The Medical Information Bureau, MIB, is a non-profit association that operates an information exchange for life and health insurance companies. Its primary purpose is to assist insurers in underwriting by detecting fraud and misrepresentation and reducing adverse selection, enabling them to make fair and accurate underwriting decisions. For instance, if an applicant fails to disclose a serious medical condition on their application, the MIB might have a record of it from a previous application to another member insurer. It does not provide medical treatment or conduct exams itself, but rather stores coded information. Question 25. An insurer's advertising must clearly indicate that the policy being advertised is insurance and must identify the insurer. This is primarily to prevent A. Twisting. B. Rebating. C. False advertising. D. Coercion. Answer: C. False advertising. Requiring an insurer's advertising to clearly state that the policy is insurance and to identify the insurer is a fundamental principle to prevent false advertising. This regulation ensures transparency and prevents consumers from being misled about the nature of the product or who is offering it. Without clear identification, consumers could mistakenly believe they are investing in something other than insurance or that a product is endorsed by an entity it is not. This helps maintain public trust and ensures fair marketing practices in the insurance industry.